All right. Well, before we get started, a few pointers in case it's your first webinar at Into the Block. First off, we will be recording the presentation. So if you're not able to stay for the whole duration of it, or if you would like to share it afterwards, we will be posting it in our YouTube channel. You can just find it at Into the Block. It usually should be out by tomorrow. Other than that, we'll be having questions. You can have questions through the Q&A and the chat. If it's regarding a particular slide, I'll keep a tab here on my monitor and might answer it. If not, we will have a more detailed Q&A at the end. And yeah, other than that, let's get started. So for today, as you know, we'll be talking about crypto derivatives. So we'll be starting from the basics, make sure everyone's up to speed, talk about an introduction to derivatives and their growth, particularly within crypto, how they've gone from basically $0 in volume to trillions this past year. We'll analyze key derivatives indicator to consider whether you're a trader, whether you're a long-term investor. We take a look at key indicators that you should consider regardless. And finally, we'll dive into some of the more advanced strategies that people can use through derivatives, financial opportunities, as well as opportunities for protocols and things that are being built and continue having potential long-term. First, though, as usual, we'll give a quick update about partnerships at Into the Block. We've had 3 main launches so far this year. Key one being WazirX, which I believe is one of the largest Indian exchanges, which is a great partnership. We also announced Let's Bit today, and we'll be announcing our partnership with Domain Money shortly. On the product side, perhaps more important, we're launching a set of new indicators. We've been working on these for a while and have been teasing it within our newsletter. We'll be releasing 5 new indicators, giving deeper insights into buying and selling activity from holding groups. So here, for instance, you can see the large holders flows. So you can track if they're net buying or net selling, considering whales and investors. Also information on the activity for holders of 1 to 10 BTC, 10 to 100, etc. So those groups within 10 BTC to monitor their growth over time. And we've gotten overall several requests for these indicators and have been teasing it. So we're very excited to be launching them likely early next week. Okay, so without further ado, let's dive into derivatives. So at their core, derivatives consist of trading contracts based on financial instruments. So these financial instruments are typically one of these 3. So it can be an asset, such as Apple stock or Bitcoin or gold. So commodities too, or however you classify them, but an asset nonetheless. It can be an index, so a pool of several assets, such as the S&P 500 futures. It can even be interest rates, so you have derivatives on treasury yields. The most common types of derivatives are futures. So these are contracts where you essentially have the agreement to buy a given asset by an expiration date, typically. So if you buy December 2022 futures, you're betting on the value of something, if you're going long, will be above that value that it is now. Of course, crypto has adapted that to perpetual swaps, which I'll get into later. Then there are options, which are also a massive industry, of course. These are like they're a right to buy something as opposed to just an agreement to do so. So you can wait until the expiry date, like I was explaining in the December 2022. And if it's not above that threshold that makes you profitable, you can decide not to buy it. Usually it does it automatically if you're not profitable. So you just pay the fee up front, which is your risk, but you take less risk in case the asset falls further. You even have swaps, which are the exchange of 2 different yield-bearing instruments as well, which is more common in the traditional finance than in crypto thus far. What are the use cases for derivatives? So of course, these are well known for their leverage associated and the speculative activity that they provide, particularly within crypto, but also really in traditional finance. So you do get the possibility of having high leverage. So you have conviction, or you're a speculator and want to bet on something. You have the possibility through derivatives that typically spot exchanges don't get to that extent. You also have the possibility to hedge against risk of an underlying asset. So in case of crypto, for instance, if you're a Bitcoin miner, a very clear use case is to buy put options in case the price of Bitcoin depreciates, their revenues sustain at a certain level, given that their revenues are directly correlated with Bitcoin price. It also provides, given that they become very highly liquid markets, they typically are cited as the source for price discovery. Since they trade higher volumes, essentially the order books are thinner and provide more accurate prices, given the higher liquidity I was referring to. And it provides the base for several strategies, market neutral and directional. So one of them being arbitrage. I'll get into some of these later into the presentation. And it's worth noting, as you might imagine, that these are all can be at least highly risky if you're not familiar with how they work. So in the case of crypto derivatives, the one leading sort contract that's traded is our perpetual swaps. So these are an extension of futures adapted to crypto's nature. So they're 24/7, so the contracts do not expire. They're trading constantly. And what they do to not have an expiration date is that they introduce what's known as a funding rate, which I'll talk into how you can use that. And the funding rate essentially charges long holders if the contract price is above spot price. So that fee creates a market force to push price back into parity with spot price. And it also does the opposite. So if a lot of people are shorting the contract, and it's below spot price, it creates a funding fee that charges short sellers, such that it creates market force, again, to bring those two one-to-one. And of course, crypto being a very speculative industry, they have the options of getting higher leverage than in traditional finance. So here's a small overview comparison of TradFi, so traditional finance, CME being the largest derivatives marketplace, centralized finance, so Binance, perpetual swaps, for instance, and decentralized finance derivatives. So right now, for Bitcoin, CME is trading roughly 1 to 2 billion per day. It does so in contracts, which is different. So you have to calculate that. Each contract is 1 Bitcoin or 0.1 Bitcoin for the micro futures. CeFi, so Binance in particular, has taken the lead here with very, very high volumes of 20, 30 billion per day. And over the past year, or really since the fall of last year or so, DeFi derivatives has really taken off, in particular DYDX, which is now trading 2 to 4 billion per day. Then max leverage, in particular for BTC contracts, is just 2x for CME, whereas Binance and DYDX offer 20x, and some of the other venues offer even higher. Used to be like 125x, but there's been a lot of criticism, so they're now decreasing it a bit to more reasonable, still very highly risky levels. Another key differentiator is the minimum order size. So since these contracts are more analog world in TradFi, they only support larger trade sizes, so 0.1 Bitcoin, which is roughly $4,000 right now. And CeFi and DeFi have much smaller market sizes, being more open for people to trade. And they're denominated in crypto terms, of course, typically in USDT in terms of CeFi, and DeFi is USDC generally, which has been more adopted by DeFi in general. And another differentiator in the case of DeFi that I'll talk into is that a lot of these services and contracts can be composable, so you can do more interesting things by combining them with other protocols within the blockchain ecosystems. So a brief timeline on crypto derivatives. BitMEX launched this on 2014. They introduced perpetual swaps. Then in 2017, of course, you see the whole institutions are coming narrative coming to fruition with the CME and CBOE launching futures. Then in 2019, the centralized exchanges that were used for spot pick up on this growing activity in perpetual swaps, and many of them, including Bitfinex, Binance, and Kraken, launch perpetual swaps. And here's a chart from Binance, the market share of volume between perpetual swaps and spot. And you can see here that within a matter of weeks, it was over half of the volume. And I believe now that's closer to 15 to 20%. So you can see how the tables have turned, and right now derivatives are already by far the most liquid contracts, the most liquid way to trade crypto. Ina is asking, will we have the link of the recorded presentation? Yes, we will be sharing it in our YouTube page later, tomorrow. And so crypto derivatives have grown from trading about 100 billion per month in late 2019 to over consistently over $1 trillion per month in 2021, especially throughout April and May. It reached a high of 2.6 trillion within a month, and a total of 25.6 trillion in 2021. So you can see here, derivatives are getting massive. This is just for Bitcoin, by the way. So as a whole, it's likely to be closer to 50 trillion, and it's grown 5x in 2021 versus 2020. And of course, it used to grow at an even higher pace before. And now I want to dive into some key indicators that you can use from derivatives, whether you're a trader, a long-term investor, or just curious about the space. So you can derive a lot of value from derivatives market data. I would argue that given the relevance of derivatives in terms of liquidity, they've become a must for every trader, especially for these highly liquid majors crypto assets that are very traded and have relationships across macro markets. And they can help, derivatives indicators can help gauge momentum. So if the market's being bullish or bearish, tops and bottoms. So when the market is overbought or oversold too. And regardless, and I believe this data is useful regardless of whether you're trading derivatives yourself or not. So I'll start from the basics here with indicators. So of course, I assume you guys are familiar with volume, which is just the total amount of contracts traded. Then you have the open interest, which is something that doesn't really apply to spot markets, but it does apply to derivatives, which is the total amount of outstanding positions. So it aggregates the amount of positions that are both long and short. So here I have a brief example of how someone can buy, and then there's $10 volume and $10 open interest. But if they close a position, and the volume aggregates adds that to, like, if they close 3 contracts or $3, that adds the volume, increases it even further, but decreases the open interest. So here you can sort of get the difference between the two. And open interest has also been increasing quite significantly throughout 2021. You can see here, it did, however, hit a higher high in November, whereas trading volume in last year for Bitcoin peaked towards April and May. But in general, it's seen very significant growth for the past years. And by analyzing open interest relative to market cap is one of the indicators that I tend to use and typically cited in our newsletter. you can get better insights of why open interest might be increasing, but volume not, as well as the positioning of many of these traders. So you can gauge the growth of perpetual swaps themselves. So of course, as perpetual swaps have increased, the percentage of open interest relative to market cap has been an uptrend. But you can see moments where open interest spikes suddenly or crashes all of a sudden. You can understand whether people are being mostly long and getting liquidated, like was the case here in May. Or here, you can see that as prices crashed below 30K, people started shorting it aggressively. So the open interest increased. And back when, just when prices started increasing again, you see liquidations on the short side. So I was covering a similar trend occurring here in early January after crashing 40% within a matter of weeks, citing that a potential short squeeze could happen. And indeed, we had a brief upside price activity, even though that's sort of stopped, and we see the continuation of the pattern at this time. I have a few questions, but given the time, I'll leave those to the end, by the way. Turnover ratio is another indicator that we use at Into the Block. And it is essentially just a ratio of volume relative to open interest. So since crypto is very volatile and there's a lot of trading activity in it, turnover, so the level of volume relative to open interest tends to be quite high, especially in days of high volatility. So that's why we overlay the volatility here in the indicator in a dotted line. And you can see the correlation there. And it's essentially a way to monitor short-term speculation in the market, since open interest tends to be longer bearing positions, while volume can often be just people intraday trading and speculating on short time frame moves. Another key indicator that's become one of the most cited across crypto is the funding rate. So as I explained, this is a fee charged to stabilize the contract peg, and it can be very useful to spot potential tops and bottoms. So here we can see in March 2020, as panic surrounding COVID and the recession came, we see a drastic drop in perpetuals funding rate, as a lot of people were shorting it aggressively, thinking that we would go to 1000K Bitcoin or something, as the people were just in stark panic because of the situation. Similar in May, of course, to a lesser extent, but we do see that perpetual swaps funding rate get very negative there at the bottom as well. And we also see in the tops, so in April and November recently, we also see people getting overly bullish, and that being reflected in the funding rates here. So another indicator that can be useful, this is not for perpetual swaps, this is for regular futures, which also trade for crypto. And this is very often cited in traditional markets, is whether these contracts are in contango or backwardation. So it's a fancy term for it saying essentially if the futures is priced higher or lower than the spot price. So here we put that into context into the block indicator, and we show how when the contract is priced at a premium, it's in contango, and here in backwardation. And you can get a sense of the shift in sentiment and expectations from the market through here. So naturally, as time converges and a contract approaches its expiry, these contracts tend to go downwards, approaching zero. But here you can see a shift in momentum from late September to early October, even slightly before prices in Bitcoin started increasing. We see that the contracts go into steeper contango, so a higher premium, and that was eventually reflected in Bitcoin price. And here it starts slowing down in October, and of course then in November we see Bitcoin hit a new all-time high, but then crash back and the contango diminishes. Okay, so that's it in terms of indicators that you can use to gauge the market. Now I want to dive into some of the opportunities and essentially cool stuff being built around derivatives. So you can use derivatives for financial gains, of course. And one of the most common ways to use it for advanced financial institutions, such as hedge funds, are through market neutral strategies. So market neutral or delta neutral essentially mean that you're generating interest without being exposed to the price of an asset. So particularly in cases where prices of assets might be going down, these opportunities can be very promising. So throughout the course of 2021, one of the most common ways to do this was the carry trade, which essentially is since these contracts that I was showing were in such a high contango, so long-term contracts back last year provided like a 30–40% premium relative to spot. So essentially, what the strategy involved was shorting those futures and longing the spot, and essentially over time those two converge. So you get the difference. So you get that 40% yield that, of course, starts to diminish as contracts approach their expiry. But in theory, it's a risk-free way to get yield, and naturally was one of the most popular trades amongst financial institutions last year. You can also earn yield from diverging funding rates. So if you're trading a perpetual swap for the same asset, if one is paying long people for longing it, and the other one is charging people for shorting it. So if one has positive and the other one has negative funding rate, you can just short the one with a positive funding rate and long the one with the negative funding rate. So you can earn interest from both and do it with the same amount and essentially have a net zero position, so no exposure to price. And you can just benefit from the perpetual swaps funding rates there, as well as arbitrages in price, although that opportunity, I'd argue, is to a lesser extent since it's very highly dominated by bots right now. You can also have directional strategies. So say if you have an input of why you think the market will go up or go down, of course, you can simply go long or short on perpetual swaps or options. And something that's been increasingly popular is selling options. So you can sell calls to cover what is known as a covered call, or you can do put selling, so selling puts in case you believe there's limited downside, and you can earn that high yield from the premium of selling these options. And that's essentially the basis around structured products, which have become one of the biggest news stories, I guess, or new sectors evolving within crypto. So there are structured product vaults, which are essentially contract. So these are in DeFi, that where users deposit an asset. So it can be USDC, for instance, or ETH. And there they have automated option selling strategies, which allow auto compounding of the returns. It also allows users to save on having to consistently pay gas fees from selling options on chain. And in theory, these yields are sustainable. Might not be at that rate, but they'll continue existing since these options premiums are widely documented and also are an option in traditional markets. Given the volatility, these option premiums tend to be quite high. So there's risk involved, but there's also a high amount of returns which can be earned, as you can see here, nearly 33% by selling puts. So the first mover here was Ribbon Finance, and this has been an industry that has been just exploding over the past couple of months, with I would argue dozens of new protocols launching over the past few months, such as Stopix and Thetanuts also getting some traction. So what are the risks and returns involved with these? So since they're directional, users are exposed to price going above a certain strike price. So the strike price is just the price that you're selling the option at. So here with a covered call, you're selling at you're putting at a price of 3,700, which essentially means you're owning, you deposit ETH in this case. And as long as ETH's price is below 3,700, your position will be earning a yield. So you get this return distribution, and you can sort of assess to what extent typically, like within a certain margin of standard deviations, that the returns should stay above certain margin. So if that's the case, if the price of ETH does in fact stay below this, and this can be very interesting, of course, in a bear market, then the user earns this yield, which in the case for this week was 0.16%, which translates to annually earning about 6.5%. So that's one of the leading, I guess, subsectors within derivatives in the past few months. And we've seen Ribbon go from 10 million TVL, total value locked, to nearly 300 million now. And their competitors, I would argue that, I would assume with competitors altogether, they're nearing 1 billion total value locked. And as yields drop in other industries, this is another industry that we're closely following at Into the Block, and I think it's very interesting for anyone interested in the space. Other than that, I think something that's worth highlighting is that derivatives in the traditional market is one of the most opaque industries, and so DeFi gives that opportunity to have a transparent look into all the activity taking place. I don't know if because of that, but it's still gaining a lot of traction. So DYDX volume has gone up 100x since they launched on layer 2. There's a growing number of protocols and across a growing number of blockchains launching. So you can see them now in Solana, on Avalanche, Polygon. Derivatives are going cross-chain, and within each chain there's typically a few native protocols. So that's causing a Cambrian explosion in the number of availability of offerings for users to use derivatives. And there's a lot of experimentation involved, as well as, of course, unique to crypto, the fact that you can own a lot of these platforms and in many cases be rewarded for using them, as was the case with the DYDX airdrop. So for the road ahead, I think it's worth pointing out this very simple thing, that is that derivatives are just trading contracts, right? And crypto smart contract platforms enable you to get additional utility from contracts. So I think it makes a lot of sense that we start seeing a lot more experimentation and growth in DeFi derivatives. So once you get like a model that starts working, it's very easy to replicate since it's open source typically, and that can lead to a very significant quick growth expansion in derivatives. So once Uniswap got the AMM model together and it started working and getting some traction, it quickly went from like 0.1% market share comparative to centralized exchanges to about 10%. So 100x% increase just in market share. So I think derivatives are in a spot where DYDX starting to get some traction comparable to centralized exchanges, and also Ribbon and structured products are too. So I think they're sort of nearing a tipping point where that growth can accelerate. And one of the things that can start being done once these are already like successful and liquid is that you can start leveraging composability. So for instance, in Uniswap, I'll go back to that comparison. In Uniswap, you can put in a vault, an LP, sorry, and you can borrow against those LPs, at least with Uniswap v2, Uniswap v3 soon. But anyways, intricacies aside, you can borrow against your LP position and I expect that to be the case against positions in perpetual swaps and structured products as well, once these become liquid enough. This is already in a way starting to be seen with staking derivatives, which we discussed in the last webinar. So you can borrow against staked ETH. And I think it's just a matter of time till we see that with other derivatives. And one very cool thing that's in development is the new standard called ERC 4626, which is a standard for yield generating vaults. And we've seen time and time again, once there's a standard for something in crypto, adoption on that just skyrockets. So first was the ERC20 token, of course, standard, and we see millions, well, at least tens of thousands of tokens now. Same with NFTs and the ERC 721. So once we start getting more adoption of a standardized yield generating vault for derivatives, I expect that composability and increased expansion to just go crazy and start blowing our minds again. So in conclusion, I think derivatives are a key component of financial markets. They are both in traditional finance and they already are within crypto. They have grown significantly, so 5, 10x, even more in the past year, but still have room for more growth. Within DeFi in particular, I'd argue they're still in their infancy. They still haven't gotten that mass liquidity that I was just describing that I expect to be happening over the next year or so. And overall, I think it's a very exciting point for the industry, and that you should expect a lot of innovation and growing market share for derivatives in crypto. Okay, thanks everyone. Let's dive into questions. And I see we have a few questions here. Okay, so Soma has a few questions. They always say there is a one-to-one shorts and longs in derivatives. If everyone is longing because it's a bull market, who's shorting against that trend? So I'll answer that first. So yeah, what you're referring to is that there's always a buyer and a seller for that trade. That totally makes sense. But if not everyone is longing just because it's a bull market, by the way, especially since there's funding rates. There's a lot of people that are shorting it, even during bear markets. But of course, when people stop, I'm just going here. When people start stop longing it, you see the funding rates go back towards near zero. So the excess in volume and urgency to long something leads to that increase in funding rate, which hopefully you understood from me from this point. And second question, how does the spot and derivative prices affect each other? It's an interesting question, and I'd argue it has to do with which is more liquid. So used to be the case in Bitcoin and crypto in general, where spot markets lead derivatives markets. Nowadays, given the high volume and level of sophistication involved in perpetual swaps and derivatives in general, it's sort of the opposite now. So we see here, for instance, I mentioned how the rate of contango here started increasing slightly before even Bitcoin price increased. So a lot of times derivatives traders are ahead of the curve in a way in terms of prices, which is yet another reason to keep a close eye on them. Few more questions. Connor Riley, thanks for joining us, has a question. How exactly do derivatives open interest flush affect spot prices? So that's a good question. So we see here, let me go back to the open interest chart. We see here when there's a lot of liquidations when there's price going strongly in a direction, we see a lot of liquidations take place. And essentially, since a lot of these markets are traded by bots, and as I was describing, a lot of times derivatives traders are leading spot markets just because of the sheer amount of volume and net positions involved. A lot of times when funding starts going negative and there's a lot of liquidations in the perpetual swaps market, that ends up being reflected, typically driven by bots in spot markets. We're also following the same pattern. So it's a lot of short-term momentum traders who have algos, which essentially both take the advantage of buying these liquidations, as well as benefiting from those quick drops in prices, which can provide high amounts of yield. Another way you can see this is on the relationship between the volume to open interest and turnover ratio. So when you see high spikes in volatility, so I believe here on December 4th, there was a high amount of liquidations. And notoriously, the amount of volume relative to open interest also spiked. So there was like 17 times as much volume as open interest in Binance that day, as people start taking advantage of that volatility for short-term trading. Fernando Villar is asking, how do gas fees affect the trading on DYDX? So in the case of DYDX, they're on a layer 2 called Starknet. Starkware. I guess Starknet is still coming. And Starkware, you have to pay the gas fee to deposit into that layer 2. But once you're in there, there's no longer a need for gas fees. What they do is it's a bit more centralized. But what they do is essentially just charge trading fees, and you don't have to pay gas fees, which of course can be very high in the case of Uniswap transactions and all. So that's been a major force for DYDX and derivatives to keep growing on layer 2. A few more questions here. Rob's asking, I'm new to investing in crypto. I've noticed several rug pulls in DEX and centralized exchange finance. Can you give me an example on what to look for when picking an exchange based on into the block indicators? It's a good question. I'm not 100% sure if from into the block indicators you can derive that. I guess from open interest, I don't have it by exchange here, but you can see which exchange is most liquid. This is not like just because it's the most liquid, it's not necessarily the most rug pull free, but it's at least there's confidence in it. So and in the block page, we have the open interest by exchange. So you can track that, and typically the most liquid is something, it's a platform where there's a lot of trust in it. So that, of course, not financial advice, but typically it's the best option to go just for the one with the highest open interest. Felix is commenting, the derivatives data you have are very nice. Thank you. Does Into the Block provide API keys to access this data more smoothly? At the moment, I'd have to click through all assets and download CSVs. Yeah, I hear you, Felix, and it's something that we've been requesting our engineering team. So I do a lot of the analysis like these myself by downloading the data. And we're working towards having the API availability for our general users. Right now, we only have it available for institutions. So it's a more select offering, I'd say, where we can define exactly what you want and the pricing accordingly. But it's in our plans to expand it to users this year, hopefully. Enrique is asking, hi, do you think DeFi derivatives markets are riskier than CDO and TradFi and could provoke a massive financial crisis? I think that's a very pessimistic view, really. Well, I was arguing here, DeFi derivatives in particular are more transparent than traditional finance. So that's the case since they're all open source. It's all in the blockchain. It can be tracked. It's sort of like the similar argument to saying that you can money launder using crypto. And yes, you could at a certain point, but right now, since it's so transparent, it's much easier doing it with cash. Same here. So if you're doing wash trading and things like that, you're leaving literally a trace on chain of your activity. So it's very dumb to do like nefarious trading here. I think there's still, of course, risk involved since there's a lot of leverage, and that reflects on the like quick swings and volatility that we're seeing more and more as derivatives have grown in size. I don't think, at least for the foreseeable future, though, we have the possibility of DeFi derivatives causing a financial crisis. Gabriel's asking, which use cases for options do you see in the crypto market which are not yet established, as in traditional markets, or vice versa? So in traditional markets, swaps are very used. So where you swap one product, one yield-bearing interest product for another. So if you're essentially, for instance, if you have a contract that earns interest of 2% based on, I don't know, gold miners' profitability, and you want to take that, like diversify that risk and get another type of risk, another type of yield into your offering, you can create a swap. I think that because it's more case by case, you would need that. Those are typically managed through OTCs. So I think there's a potential for that to be recreated in crypto. It would be hard to do so in a decentralized way, but maybe through a peer-to-contract interaction could be possible, sort of what the approach that lending markets take. And I think there's a lot of products and innovation really taking place in crypto derivatives that will likely, in the long term of things, see in traditional markets as well. So I think perpetual swaps, not having an expiration, having this novel mechanism to push prices to a peg, I think it would make sense. Also being 24/7 trading, native to the digital world, I think it makes sense for eventually stocks to trade in perpetual swaps. I know it sounds crazy, but in a future where a lot of value goes to the blockchain, I think it will happen eventually. And I think there's already attempts at that with synthetics and Mirror Protocol and Luna, even though at a very small scale. Few more questions as we're running over time. As you have shown in the presentation, currently there's almost no backwardation compared to 2021 bull market. I think you referred to contango, but does the low level of backwardation suggest that we're approaching a bear market? So in the case that I showed, this is for a contract expiring in December 31st, 2021. So the premium, as I mentioned, naturally moves towards zero. So the contango diminishes as the contract expiry approaches. That being said, we're still seeing that premium to decreasing and going towards backwardation, so at a negative level for contracts expiring in March of this year. So I'm not saying that we're going to a bear market because of that, but it definitely shows that there's more cautious sentiment and less betting on long-term gains. So on short-term really since it's March. So it's showing more cautious sentiment and slightly bearish, I would argue, but doesn't necessarily guarantee like a full-on bear market just because of that. All right, I think that wraps it up in terms of questions. Thanks everyone for joining us. Hope you all have a great day. Okay. Bye now. Have a good day, everyone.